That's with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
Good afternoon. Welcome to this Friday edition of The Call. 10 companies picked by you, 2 expert guests, all in the space of 1 hour. Plus, we will also speak our future fund stock picks. I'm Nadine Blayney, and a warm welcome to those of you watching us live on Twitter and YouTube. We look forward to seeing you as we do this show throughout the week on our website and via the app. We live stream from 12 to 1 p.m. Eastern, Monday through Friday. My 2 expert guests for the next hour. Very pleased to welcome Jun Bei Liu from Tribeca Investment Partners and Claude Walker from A Rich Life on this Friday. A big warm welcome to you both.
G'day,
Claude,
great to be here.
How are you feeling?
Friday.
Thank you. I know, Jun Bei, happy Friday. Look, we had some big news, restrictions lifting in a meaningful way, really it seems, from Monday. Jun Bei, what's your general sense about this whole reopening trade? I mean, we saw the travel names take flight, have pulled back a little bit. Is there a recognition that, we're not going to be taking to the skies anytime, really, still, that soon?
Yeah, that's actually a very interesting point. A lot of reopening stocks sort of have a little bit of pullback, really on the basis of investor taking a reassessment of what is being priced in. For the travel agents, it's probably still going to take some time. But for Qantas, look, I think the domestic booking is going to pick up significantly very quickly once the borders start opening again. So, it's pick and choose at this point, but certainly the sentiment is going to be very positive as we reopen. As we know, New South Wales is a big part of the economic contributor for Australia. It's looking pretty strong heading into Christmas for us.
Good. Now, Claude, a bit slow on the news flow front from big corporates. We're heading toward AGM season. Has there been a lot of news flow in the smaller end of the market?
Well, the big news sort of yesterday evening, and which is playing out now in the stock market this morning, is EML Payments, which is a company I used to own myself, actually. And it actually made an acquisition of an Irish company actually in 2020. And yeah, that Irish company has not been great for it. No. It's had a few little regulatory snafus, but I think what people tend to forget is that money laundering risks are super serious, and a company can really end up in trouble and do it basically, this is a big deal. It's not like a little thing that people are focused on, just the slap of the risk of the fine, but actually there's a real problem if your business is on the wrong side of these laws. Now, I've got no idea what's going on with EML, neither does the market, but obviously something's going on because they're having all these discussions about, banking laws with the Central Bank of Ireland, and it seems like they're going to have to change their ways in some way, and that's not cool.
No, well, EML, to your point, time stamping this just past noon here in Sydney on this Friday, down by 13%. I have a feeling you're going to be doing some work on that one, Claude. We might hear more on it a little bit later on. Let's get to our future fund stock series. So you've heard us talk about this for the past couple of weeks. So our guests have been picking long-term, high-quality stocks that they would buy to put in the bottom drawer to help cover all the future education costs of, well, in Kashi's case, it's been grandkids. My case, perhaps a bit more geared toward the kids. Claude, you were generous, I think it was last week, with your pick, which was Google. So we'll go to Jun Bei. What would you think would have a pretty good chance of capital return that will be big time in a decade or so?
Look, for these companies, I'm going to pick something out of Australian markets. Even though we're not as diverse in terms of high quality growth businesses compared to the US, but still we have a few really strong, homegrown high growth leaders. So this name we're going to talk to is Pro Medicus. It is a global leader now in a very fast growing radiology software and enterprise imaging space. Now, this company has won something like 9 out of 20 top US hospital institution as customers. And as you know, once they win a hospital, they start then growing significantly within that hospital, but they already have top 9 out of 20 using their products. And they also have a research and development sort of collaboration with large institutions, a very reputable institution like NYU. And soon they're talking to many new exciting business lines, things like AI, that could potentially opening up more global opportunities for this business. It also won so many contracts, even during COVID, where many have thought, the earnings might take a step back. So look, it's incredible growth business. It's expensive, but it is something that in a few years' time, it won't look any more expensive than some of your local slow growing businesses.
Thank you, Jun Bei. So your pick is Pro Medicus. Look, I don't think you're going to disagree, Claude, are you?
Oh, I mean, that is just like music to my ears. I love it when other people recognize the quality of that business. But, full disclosure, another company overtook Pro Medicus as my largest ASX shareholding not long ago, and I just had to sell a little bit so Pro Medicus could be back at the top.
Right. Okay. Good one, Claude. Jun Bei, thank you for that. That brings this Future Fund Stock Series to an end. We will make these companies accessible to you, our viewers, if you'd like to take a little bit of a look back. And next week, just as a heads up to you two, Claude and Jun Bei, over the next couple of weeks, we'll be getting a pick for a potential crash. So a stock that you've got an entry level in mind for in case there is a more significant pullback on markets in the next little while. So there you go, to just keep people entertained and informed. Of course, that's what this show is all about. Let's get to some of the companies that have been picked by you, our viewers. Jun Bei and Claude have done their research. And look, Jun Bei, I'll start with you on this first one for Craig. It is Infomedia, IFM. Look, it's in the auto parts and services, but it's software. It's software and it's data. Jun Bei, what do you make of Infomedia?
Look, this company has been, in terms of the earning, it's been impacted by the COVID disruption of, inability of selling car parts and things. Essentially, it's like a digital catalog for a lot of car parts and automotive industry. So it was heavily disrupted in the first half of last year. And then the second half is since it has actually achieved pretty significant organic growth and come back from, tough comparables. And the exit rate at the full year result, it certainly indicates 2022 is going to be a pretty good year for this business. It's not super cheap. It's about 23 times on next year's earnings, but it will grow something like a mid double digit sort of growth, and it seems mostly organic, and it does have a bit of a sort of tailwind in terms of currency that sort of benefit this company. I will put that on a hold at this point because turnaround for this year is still looking like will be probably second half weighted, but it certainly looks very interesting, and it's not super expensive for a growth company that has a reopening thematic to it.
Thank you, Jun Bei. So that's a hold for Infomedia from Jun Bei. Claude, what about you? I mean, it has done cap raisings, looking at acquisitions, but has a pretty steady recurring revenue base.
Well, that's exactly right. And, I guess full disclosure up front, Infomedia is my favorite company that we're going to talk about today.
Okay.
It has what I look for in business. Now, I don't own it myself, but I really love to see software businesses that are globally scalable with high recurring revenue. And Infomedia, whilst it has had its problems over the years, it is those things. And the reason that kind of business model is good is because it makes that kind of business a survivor. It's very hard to kill high recurring revenue businesses because they can respond to problems as they happen and try to keep that revenue going back up and fix problems. They've got time, they can see what's happening, they don't get blindsided. And on top of that, basically, I think that software is just the best business model because it scales so well. If you can just roll it out to new customers, your costs never really go up as much as the actual revenue that you can get. So as these companies get bigger, they get more powerful. Now, Infomedia is a really interesting one, and it's one of the cheapest sort of decent quality software companies you're going to find on the ASX, generally speaking, because it's had such a checkered history. If you look back, maybe we could even look at that 5-year chart, but basically, if you look at over the years, it's been a bit of a bumpy ride. I think, there's been some misjudgment of the business at certain times and a bit of overexcitement, but this one has not been the kind of long-term, decent, fast, secular grower that you would look for when you generally want to find the best software businesses. Now, having said all that, a lot of what I've just said is arguably historical, and I think we actually come to the stock at an interesting juncture in its story. Now, the reason for this is that the Microcat electronic parts catalog business that it runs, that's its software offering that helps people acquire secondhand parts replacement parts for cars and the like. That's been turned into what they describe as a powerful parts selling platform, and the menus platform has been substantially upgraded and streamlined to meet our customer needs. And what they basically say in their most recent report is they've just rolled out what they're calling next gen, I guess their improved products, to more than 220,000 users in 186 countries across the world. So most of those users are now saying that this makes them more efficient and it's better for their business. So this possibly suggests that they have a new product that is better than the old product. Now, if they've been surviving and kind of bumbling along with some wins, some losses over the last few years with their older products that were probably in dire need of an upgrade, they're now saying, hey, we've upgraded our products and our users are saying it's better. That is a qualitative factor that hasn't yet come through in the numbers. Now, we don't know if it's going to come through as an uplift in the business and a new stage of its growth as a business. We don't know that yet. But at the same time, I think that analysts are expecting a modest growth next year. And based on what analysts are expecting for modest growth next year, or decent growth, these guys aren't that expensive. I think that they're, between 10 or 11 and 15 times earnings, more or less, and depending on where you land with your estimates. But basically, I don't think it's really priced very punchily, right? For the fact that maybe they've got a qualitative improvement to their product coming out. So for that reason, I would argue that the risk reward is in favor. And so to the extent that it is, decent and proper to do so, I would call this a buy, despite not actually owning it myself. But it's just, I could actually imagine myself owning this one. It's just not made the cut for my portfolio at this stage, but it is interesting. I think so.
But so what are you waiting for? Is it price particularly?
Yeah, so this thing popped up a little bit. So I was talking about some of those quotes from the recent results. Yeah. Now, what happens is we get this deluge of results, and it's really hard to go through them all quickly. And so by the time I'd actually had a look at Infomedia's results, that share price had popped up a fair bit. And basically I'm kind of half thinking that, in August, it kind of moved up, and I didn't look at it. So I thought, maybe this is one to buy before the results. And anyway, now I guess what I'd be waiting for for it to come down a little bit. And I have to say, already I think it looks pretty good, to be honest. But we've got a bit of volatility at the moment. You never know. I'm pretty fully invested. That's just the truth of the matter, basically. So I have to basically sell something to buy something new. Hence why I don't own Infomedia. Okay,
interesting. Thanks, Claude. I'd let you go because it was interesting and this is your favorite one. So I have a feeling you might be short and sweet on some others. No, I'm happy. I'm happy about it. All right, let's get to Sims. This is for Ellen. Jun Bei, for you. Now, we always think of Sims as this metal recycling company, but I was flipping around, as you do, watching TV the other night and watched a really interesting thing on Sims and its e-waste recycling facility in the US. Sims has that. It has a waste-to-energy plant in New York. I mean, how do you look at Sims?
Yeah, it's true though. So Sims does have a green tilt or renewable type of space to it now. Previously, it used to be just scrap metal, and then they try to trade them and the like. But now these days, it is part of that recycling. Many businesses do have that sort of facility, and Sims is investing big time into that space. It does have that good tilt to it, but that's yet to be a big part of the earnings. Quite big part of the earning continue in the trading of the scrap, and the trading of the prices, and the scrap prices will lead its future earnings at this point. Certainly, Sims at this point is probably neutral. Share price has done a lot in the last 12 months. Despite COVID and the like, just simply because the scrap price has turned around very, very quickly. Sims is not a high quality company, simply because when I say the scrap prices can move around a lot, when they do move, there's not much Sims can do. So its earning can move from profitability to losses very quickly and back to profitability. And right now we are in that up run, so things has gone quite well for the company. Now the problem is at the moment, because iron ore price has come off a lot, and scrap prices have shown historically a good correlation in terms of trading profits out of the scrap, a good correlation with the iron ore prices. So it certainly seems like a Sims earning might be a little bit soft heading to the next quarter or so. And on that basis, you kind of don't want to be in a company like that when the earning is turning. So I would avoid it.
It is a cyclical company, so it is an avoid from Jun Bei. Look, I should say, Claude, watching that show on the e-waste recycling, they were emphasizing over and over how difficult it is, how cost intensive it is, and how much the people who make our technology should be making it easier to recycle. Anyways, that's just a thought. That aside, would you ever buy into a company that's as cyclical, to Jun Bei's point, as Sims?
Well, I'll tell you what I'd need to want to buy into Sims. I mean, the answer is possibly I'd do anything. I'd never say never in terms of the stock market. But what I would want to see with Sims is really strong government action to actually make businesses like Sims more profitable, and thus encourage more people to get in the game, which would hopefully have the effect of making Sims massively more profitable. That's what I'd like to see. I think this is good capitalism, and the government should be doing more to support this and less to try and subsidize coal mining. And so, this is actually one of the first businesses I looked at when I started investing. I think that it's really important that people do these activities. But as Jun Bei said, this is a bad quality business. Like, over the last 10 years, I think that in 4 or 5 of those years, they made a loss before taxes, right? So, I mean, in the long term, you could almost just flip a coin to see if it's going to make a profit this year, which of course makes it very difficult to know if you're paying a good price and all that kind of thing. So, definitely wishing these guys heaps of luck, but I just couldn't really foresee, actually, in reality, a situation where I would buy them. Maybe if I was making some sort of macro bet on the scrap price or something like that, I would buy them in that scenario, but it's just not the kind of game that I regularly get up to, so it'd be an avoid for me. An avoid, but with appreciation for the business.
Yeah, right. Well, Ellen, so that is not exactly a ringing endorsement for you of Sims Metal. So let's get to the next company that's on our list, and that is number 3, being Race Oncology. And we've got a bit of context coming from our viewer, Paul, who says they're looking to sell to Big Pharma next year sometime. And he says it's got a great team. In fact, he says one of the smartest teams on the planet. No way of fact checking that one. He says the drug is groundbreaking, first class, best in class, could be, this big prospect and even historic. Now, this is the words of Paul. Jun Bei, when we look at biotechs, we so often talk about there being some sort of a binary outcome, right? It either goes massive or fades away or requires a whole lot of capital for a very long time. What do you think of Race Oncology?
Look, I think it's probably a little bit early stage for me, whilst the drugs sound amazing. And one thing to be mindful of is that over the last however many years investing in the Australian market, we have a lot of biotech or medtech coming through the ranks over the years, and all of them look very promising. And however, usually the hit rate of when the drugs does go from development clinical study phase into the full commercial phase, the successful story have been very rare. We do have a few large ones like CSL and ResMed and Cochlear and the like, but many of them do fail. So this one looks very promising, but however, seems like it's in that phase 2, phase 3 stage. Normally investing in biotech, unless you have very strong intimate knowledge of what this particular drug is, and really understand what it is, you tend to avoid when that study outcome comes through, because that's when it's binary, because either sometimes the clinical study was not designed properly, or sometimes it's something else. So there's normally a very high risk of share price disruption based on those. And also, once you get approved, there's the issues of how do you sell it? Who do you partner with? Do you need to invest in sales team, or do you just sell half of your business for someone else to commercialize it for you? So there's a lot of hurdles still need to be passed before you actually get to selling anything. So it's a bit early stage for me, and it's wait and watch. But whilst product looks amazing, the oncology space is expanding enormously. Study and innovation in that space is very fast. So I think I would just watch it for now, avoid for me for now.
Okay, now what do you make of Race Oncology, Claude?
Well, I agree with everything Jun Bei just said. And I'd just like to add, to try and, zoom in on this particular company. Because I am not a biotech expert, when I look at biotechs, which I've sometimes do just out of interest, I tend to try and actually just look at who are the knowledgeable and smart investors that actually might have the means to understand the risks and rewards of a biotech better than I do. So I agree with what Jun Bei said. This is too early stage for me. I wouldn't invest in it. However, the task is for me to make a comment on it. So what I've actually done is had a look at, who's been investing, who's doing this, who's running it. And this one does look like one of the higher quality biotechs to me. I noticed that David Williams from Kidder Williams participated in a recent placement. Now, I'm sure that's part of a diversified strategy where he makes a whole bunch of different bets and stuff. But obviously, he is one of the investors that I admire for their skill. So, look, I guess it's probably one of the better ones. But for me, for this early stage kind of stuff, let me just say, of the enthusiasm that the questioner has for this company, that's great. And you have to remember that every single hopeful biotech out there also has the shareholders that love that enthusiasm and have that hope as well. And most of them statistically, don't work out so well, at least when they're very early stage. So yeah, I'd give it a miss, but I could see this one being one of the better ones. And perhaps, there are experts out there in the science that do have a better idea than I do.
Yeah, and you have to, valuing a biotech company is not necessarily for the layman, so there's skill that comes around that as well. So we'll thank you for your question, Paul, and we love your enthusiasm. We hope you keep sending them in. Let's get to the next one on our list. Yep, we're at number 4. This is for Raj. Chalice Mining, CHN is the ticker code. Now, he writes the share price has done a lot in the last year. Not sure why, but it has dropped significantly from highs, less than other gold stocks. So again, it's these people trying to make sense of some of the share price moves. Look, it is still in the exploratory phase. It, still, last I checked, was raising money to accelerate exploration activities at its Julimar mines. Jun Bei, we've talked about this before. Your investment, your style of investing is that you want to be in the names that are already producing. Is there anything to like about Chalice?
Actually, we do like this one as well. I agree. Normally, I stay with the larger ones, the Northern Star and the others. But this one, actually, we do like. We think they've got a really good resource, and we think they've got enough capital to really expand that. So what that does to this business is that, without worry about assuming gold price is going to be flat, this company will actually grow. So it has something unique about it. It will have growth in production, regardless of what gold price does. So this one is actually quite nicely positioned. Now, of course, it comes down to why share price fell. It's because gold prices has been pretty tough. Gold price, as you know, doesn't do well in between periods. So gold price does well when the inflation is flying away, or gold price does well when everyone is worried about recession, but somewhere in between is where we are at the moment. Gold price does struggle because we have real economic activity picking up. We don't really need safety haven like gold, and inflation yet to be a problem. So in this sort of environment, gold prices does struggle. So any company that base their earnings based on selling to the current spot gold price is going to struggle. So that is the key issue of why the share price come off. But like you said, this one actually has done better because it's more company specific reasons. So if I'm to hold a gold, I'll put this one on a buy. But obviously subject to what your gold outlook is, and together with my other larger gold producers, as they represent good value at this point as well.
I love this show because I can still be surprised sometimes. Jun Bei, thank you. Claude Walker, Chalice Mining, CHN.
Well, I guess no surprises for me at this time. There's no way I can add more detail than what Jun Bei just said. She clearly knows this company better than I. So I'll just step aside and say, look, I definitely don't do explorers. They're sort of the same thing as biotech explorers to me as well. So it'll be an avoid for me on that basis.
Got it. Thank you. Let's go to Mirvac. So this is a company that oftentimes our lives touch in some way, shape, or form, whether it be through retail, visiting people at their homes or their apartments, even if we don't live in one ourselves. This is for Jess, MGR. No context here. So I'll start with you, Jun Bei. What do you make of Mirvac, where it sits in the cycle, the housing cycle, the economic recovery, and the quality of its assets and the like?
Look, Mirvac still looks pretty good relative to its other more expensive property trust peers. So I'll put that on a buy simply because big part of earnings are offices. So that earning is going to continue to reopen as the economy, people return to workplace and the like. And they do hold a lot of premium assets. And the other part of Mirvac has been that, apartment, the property, high-rise property has been very, very tough for many years. And if anything, last 12 months of strength we saw in the housing market has been really belonged to the detached housing activity. And the apartment usually lags that cycle. So now we just started seeing improvement in the apartment market. We certainly think the Mirvac is going to deliver to that sort of earnings growth. Earning will grow pretty well, and it's not expensive because of the office exposure and the like. It's certainly much cheaper than the industrial peers. And I think this is a very quality asset. Also have some sort of M&A sort of tilt to it, given the quality of its portfolio. So
that's a buy from Jun Bei Liu from Tribeca. What about Mirvac for Jess? From you, Claude?
I'm a little more sanguine about this one. I do agree that if you're going to bet in the large cap real estate trust, this is probably better quality than most of them. However, I have a different perspective about the office space situation. Look, it could well be that we return to the office, just as before. And it's hard for me to tell if it's my personal bias that I think everyone's happier if they work from home and get to rock around their neighborhood rather than go into the city. And so it could be my personal bias, but I also wouldn't be surprised if this process has actually kicked off a great long period where demand for commercial office space stagnates at best. I think what we're seeing in the USA already is the most desirable companies to work for, a lot of big tech companies and other knowledge worker companies, they are definitely allowing employees to choose their work habit a bit more. Now, it's going to be normal to still perhaps come into the office, but if you've only got people coming in 3 days a week even, and unless everyone needs their separate office space, then I think that overall the net effect is you can actually probably move to a smaller office and save some money. On top of that, I think it's going to become more emphasis on the fact that offices should be about getting together and having the value of being around each other, not just coming in so that somebody can look over your shoulder to make sure you're not on Facebook. I mean, first of all, like they have software tools for that. And second of all, why are you hiring someone if you seriously think they're going to be on Facebook all day? So, look, I don't personally want to make a bet that there's going to be good, strong rebound in commercial office space. That said, the that's hardly going to kill it. Like, I think it's a good positioning, and in Australia at least, the governments always generally try to make property prices go up. So if this is what you're looking for and you want a property trust, I guess I'd call it a hold. I definitely wouldn't want somebody to, sell out just because I have a view about office spaces that may or may not be correct. But for me, I could never call it a buy on that basis.
Thank you. So that's a hold from you, Claude. Guys, we're at the halfway mark. Take a breath, have a sip of water. I'll run our viewers through what we've learned so far. Jun Bei's future fund pick, Pro Medicus, high growth, quality name, she says, and they're not always in that high growth area that easy to find here in Australia. Her pick gets the thumbs up from Claude, who of course gave us his pick last week, which was Google. To the companies that have been picked by you, Info Media, it's a hold from both of my guests. Jun Bei says it's not expensive, good way to play the reopening. Claude is really, if he had some money, I have a feeling he might be buying this one. He thinks that you could potentially get it a bit cheaper. It's a hold for him, global scale, recurring revenue, things that he likes. Sims, unfortunately, or not, but both of my guests say that it is not a high quality company. They would not be investing in Sims Metal, SGM for Ellen. For Paul, Race Oncology, again, Claude just says he doesn't know enough about biotechs, this one, the drug, to invest in it. That means that he would have to give it a miss. But he has a feeling, just by some of the research that he's done, that it might be one of the better biotechs out there. It's an avoid for Jun Bei. Again, it's very early stage for her. All of these drugs look very promising at the beginning. It's an avoid when a lot of these studies are still being done and the results coming through, because it's very volatile. And from there, commercialization becomes the next challenge. So it's just not her cup of tea. Chalice Mining, this is a buy for Jun Bei. Yes, she likes the bigger gold miners, but she says this one is quality, it's unique, and it will see growth in production. So she would buy this to hold alongside some of the bigger names that she has in the gold space, although you do need to be mindful of price and your view on price going forward. And look, Claude doesn't do explorers. He's going to avoid Chalice Mining. He's going to hold Mirvac because it is better quality than a lot of those other property plays out there. The government, you just heard him say, usually does its best to maintain high property prices in Australia. But for him, he's questioning the whole structural shift that may happen in terms of work or hybrid work at the office. Jun Bei, well, I think I can say she's probably going to go back into the office when she's allowed. It's a buy for her. It's not expensive in the property space. It still looks pretty good. She thinks offices will come back to life and that the earnings will grow for Mirvac. So that was a really good half hour. When we say buy, is it going in the portfolio, all of that, this is about the ausbiz fantasy portfolio. We've been tracking it since July the 1st last year, thanks to our partner at NabTrade. 2 companies go in if they both get a buy from the guests on the day. It's a very convoluted way of saying it. It's got to get 2 buys to go into the portfolio, and there it remains until it gets a sell. Okay, let's get to the 1 week return, just sort of flatlining it so far this week. 1 month, we're down about 1%. Full year to date, so July 1st, 2021, up just over 4%. Since the inception, though, that July 1st, 2020 that I referenced earlier on, we're up just shy of 41%. Yesterday, we added HT&E, we added Silk Laser Australia. Bega Cheese has been added recently, Accent and Calix. We've removed Nick Scali, A2 Milk, New Hope, and Medical Developments. If you'd like to look at that list and keep us honest, ausbiz.co/portfolio. All right, it's a Friday. Let's crack on with it, shall we? My stomach is grumbling. Let's get to Secos Group, SES for Alex. I'm going to start with you, Claude.
Well, so Secos Group is actually probably my second favorite company on our list today. It's one I've owned in the past. Now, what they do is they manufacture plastic bags and resin for plastic bags.
Yeah.
But where they're really their growth engine, and the reason I like them, has been that for many years they've been working on commercializing and rolling out resin that's compostable, so this can make compostable plastic bags. Now, compostable plastic bags are not a solution to the fact that we use way too much single-use plastics, which is, clogging up our entire ecosystem and now getting into our bodies. This is not a solution, but it is better than the current just do anything with plastic that never goes away ever. And they got over 500% growth in that segment in the last year. So I think that's at an inflection point. On top of that, as you can imagine, with a manufacturer, this is a business that has a fair bit of operating leverage. So, they have to invest in a factory and stuff like that. But then as they get more demand across that same factory base, their profits can go up quite quickly. And importantly, they have just crossed the profitability inflection point. So they've made their first profit in the most recent year. So that makes them a de-risk company to a degree, which can now start potentially attracting a greater variety of shareholders. So people that more favor profitable companies might start to get interested in it. And you never know, it could actually just be the precursor to it become even a dividend paying company and actually just go up and up the quality stakes there. So that I like about it. Now, but however, I did sell it slightly above current prices, and I bought it, I think, 16 cents and sold it above 30, right? And the reason is I was trying to invest to get that inflection point, which then did occur. Now, based on its profits that it has just recorded, is actually quite expensive. Just wanted to point out for anyone sort of doing a little bit of valuation work at home, you have to be careful because the net profit for this company benefited from the fact that when a company turns into a profitable company, it now gets to realize the value of its tax losses beforehand. So then it records a tax gain of, in this case, I think 2 or 3 million. What you need to do is look at the profit before tax, which was just about 500,000, right? So even though it's going to be higher than that in the next year based on their current run rate, I think, still, it really is only just profitable. So there's still a lot of risk in it. It does need to continue to grow its profits quite a lot to justify its current price. I'd say it probably will do that, but there's no longer that obvious thesis of why I would make money if I bought shares right now. So for me, I guess I'd call it a hold.
Yeah, I like this. I mean, I remember interviewing Richard Tagoni, who is the exec chair, just around those results. So interesting to have that valuation conversation brought up again, Jun Bei, because you can like the story, Jun Bei. I think it's easy to say that you like the story of fewer single-use plastic bags being out in the world. It's got global scale. It's selling into different markets. But you can't get too hung up on a story as an investor, can you?
That's right, but I must say I do like this story. When I looked into this stock, I absolutely thought this looks very interesting. Well done, Claude, for finding it before it turns profitable. Clearly that's very early stage now. Just turned its maiden EBITDA, and still it's going to double its EBITDA. And by 2023, it's expected to make. So 22, they will make an EBITDA of over $4 million. 23 is over 10. Now, these number may be a bit overstated because when company growing at that early stage of its growth, analysts just not sure which number to put on. So sometimes can be overstated. But regardless, the revenue momentum is very strong, and it's in the right place. It's selling to the right right product, and part of the reason for part of the reason for all these earnings growth is because there's enough demand for their product, and they're just expanding manufacturing capacity, like Claude said. So it actually looks really interesting. I have to do more work. It does feel like too good to be true, and absolutely they're not paying tax at the moment, all of that. So it's probably not a good idea to look at the PE, so price to earning ratio. You probably want to look at the EV, which is enterprise value divided by EBIT. Use that multiple better, because it is a manufacturing business, so it captures the depreciation as well. So on that multiple, it doesn't look that pricey. So, it's a hold for me for now. I'm going to do more digging on it. I think it looks pretty exciting.
Yeah, okay, that's great. And if you'd like to listen to a couple of interviews with the exec chair, they are on the ausbiz website. But yeah, I remember reporting season looking into it and thinking, oh, good. Let's get this going. All right, let's get on to the list. A company that many people would be very familiar with in many ways. Seek is on the list from Colin. Thanks, Colin. Jun Bei, I'll start with you on Seek.
Yeah, look, Seek, I like Seek. It's one of my top positions. I like it very much. Well, there's a few folds. One is that this business has a cyclical side component to its earnings. So earnings now, in terms of job market here in Australia, is picking up significantly, and our economic activity is going pretty well. And especially when our economy reopens and all of that, this company will have pretty good earnings growth, in the next 12, 18, whatever month. And aside from just volume growing stronger, they managed to get some yield growth to come through, so high prices per ad, and just given the conditions so hot, so strong. And if you remember the likes of REA or car sales, all of them have been focused on yield growth, and REA has been one of the most successful company in doing so in Australia. So there's a lot of revenue growth opportunity here in a very premium dominating market position in the job classifieds here in Australia. Now it also has another component to it. It has a growth vehicle. Now it's splitting out. That company offers very high growth profile and invests in many of the early stage growth companies. If anything, Seek management has a really strong track record of investing in those companies, and I do back them to be able to do really well on that basis. And the third reason of why I really like this one, because it underperformed the other classified peers. Normally they track pretty closely. This one underperformed. So if anything, this one will catch up very, very quickly.
So just to push the point, because last time you and I spoke about Seek, it was when it was sold off in one of these volatile periods that the market has gone through. So at $31.97, still a buy for you, Jun Bei, or would you be holding off to wait for any type of a pullback or a day of selling on the boards?
No, I will be buying Seek at the current price. One thing about those companies, when they have underperformed their peers over a period of time, when the sell-off comes, it doesn't sell off as much as the others. So in a way, it's almost defensive against other, expensive companies relatively. So I see this one as more defensive than the others that's performed incredibly well.
Thank you. Now, Claude, thoughts on Seek, please, for Colin.
Look, I think I agree with much of what Jun Bei just said. I do agree, certainly, that this is a high-quality business with a high-quality management team. So I guess that means that, in some ways, the discussion is around price. And look, first of all, I think it's good that they reduce their investment in the Zalpin thing. I personally think that, the more they streamline and simplify the business of Seek, the more value will probably be realized for shareholders. It has been quite, innovative in terms of it seeding new businesses and investing elsewhere and stuff. And that's fine. And obviously its founder is a well-known venture capital guy. So, they kind of know what they're doing there. But at the same time, it's the Australian business that has been the cash flow core, the cash flow king. It's almost like every government department will advertise a job on Seek, even if they already know exactly who's going to get the job from internal to the government, because they have some rules around that kind of thing. And having that kind of government anchor your network effect marketplace means that it's maybe impossible to kill your business. So that's super resilience there. That's really cool. Having said all that, look, on my numbers, it does look quite expensive. If you just look at the analyst forecast of EBIT and stuff, there's still a fair bit of growth in this. Obviously, it's a mature business now, so I don't think it's taking share in any meaningful way. So it's sort of just system growth in the jobs market. Look, we're probably going to go into a strong period if what the macro guys are saying are true. So that's probably positive. So, I mean, I'm not going to say sell of a high quality business like this, but it's not obvious to me where the opportunity is to buy it right now either. So I think I'm going to have to go with hold.
Got it. Let's get on to the next. Go with hold. Yeah, you're a bit reluctant, but it's a hold. Horizon Oil for Shane. He says it's generating free cash flow, which is used to pay off debt. Produces at only $12 a barrel. Recent returned capital to shareholder. What do you think about Horizon Oil, Claude?
Obviously it's out of my wheelhouse, and I suspect Jun Bei will have something more specific to the company to say about it. But basically for me at the moment, it looks like there's a lot of excitement in the resources, oil and gas space. And as somebody who doesn't spend a lot of time trying to make money out of macro, for me as an observer, it looks to me like probably with all of these plays, a lot of people might have missed the good bit. And you don't want to get in super late to a big sort of cyclical play on oil prices and stuff like that. So, I wouldn't buy it. It's just too high risk for me. I don't have any advantage in the market personally. And I'm not convinced that most people do either, but clearly just trend following in this space can make you money. So,
Yep.
I wouldn't poo-poo the idea, but it's definitely not for me.
Got it. Thank you. Jun Bei, what do you make of Horizon Oil HZN?
Look, my view is that I do like to stick with the larger players instead of little Horizon Oil space. The main reason being that it is the current oil price is making a lot of money, but before that it was stuck in the range for a very, very long time. So it's more large scale compared to the largest of so say Oil Search or others. And with the current high oil prices, all of them are doing very, very well. And all of them have the ability to pay back capital and making lots of free cash flow for the time being. And what's most important about investing in those businesses is that you've got to have a view of where the oil price is going, same as the gold company, where the gold price is going. Now, oil price is looking pretty strong at the moment. A lot of people are talking to $100 oil and all of that. And also heading into the winter in China and winter in Europe, there seems to be a lot of shortages around gas, natural gas, and heating oil and all of that. So it is putting a lot of pressure, on that front. So the whole sector has done very well. If anything, I think there might even be further tightness once we start. Once we start having the airline, the jet fuel demand coming through as well, because I don't know about you, but I'll be ready to book my flights out once we're allowed to do so. So there's a lot of demand for those oil, and then there hasn't been enough investment into the oil space. So for the time being, these oil companies will continue to reap pretty good cash rewards, but it's not something you want to hold for a long time, because ultimately fossil fuel is something that will be phased out. There will be renewables and others, but for the time being, the prices will stay high for some time.
Got it. To answer your question, Jun Bei, I'm with you. I'm already trolling, the travel websites to see what's going to happen next. Anyhow, let's get to number 9 on our list, Challenger Financial, CGF for Scott. Jun Bei, look, the brokers are pretty mixed on this one. Looks as if it's just pretty neutral sentiment toward the company. How about you?
I'm pretty neutral as well, because it's not exactly cheap and it's not exactly that exciting. It does benefit from a rising share market, so its funds under management will continue to grow and it gets a cut of it. So earning will continue to grow when the share market does well. It has a very, I would say, the best business within its core is actually the Fidante business, which is a distribution business for fund managers, and that's been an incredibly successful company. And now there's discussion that potentially Challenger could want to sell that asset. Now that will mean more buyback or special dividend for a Challenger shareholder. So when that announcement does get made, it will be pretty positive for the yield, for the income oriented investors. Otherwise, it's not something I feel I want to rush out to buy it. And then also think about when they do sell the Fidante business, there's a lot of other companies can benefit. There's so many, likes of Pinnacle can bid for it. There's likes of many others can bid for that business. And then the translating earnings will be more significant for those companies. So I'm not super excited about it. It's a neutral for me.
Got it. Thank you. How about you, Claude? I can't imagine that this really gets your juices going.
Not exciting enough for me. I don't think it's going to make any difference to my life if I buy and hold this stock, or has any potential to. Having said that, I think it's a pretty decent, I guess, father-in-law stock or whatever, because it pays about a 3.3% dividend. Now, analysts are expecting earnings to be pretty flat, and the pricing, I would say, is sort of according to that. I think that it's probably best viewed as a almost blue chip or a blue chip dividend stock, and 3.3%, I guess everyone can decide if that's enough of a yield. But what I would say is that look, when you invest in dividend stocks, you definitely want dividend stocks that are growing, even if the growth is low. And at a zoomed out level, these guys, their life business, that business segment, that's been growing like quite a lot over the years. And I think it has something to do with demographics. As the baby boomer generation moves into the retirement, I suspect that sort of longer term tailwind still has a way to play out for Challenger. So yeah, all in all, definitely I think it's a good dividend stock that I'd consider if I was a risk averse investor with a diversified dividend portfolio, but that's not really me. So, I guess I'd call it a hold at best.
Thank you. Let's get to the last one on the list, and that is BrainChip, BRN, from Phil. Last time I was running this show and BrainChip came up, I got in a lot of trouble for apparently giving it too short a time to be discussed. But that, of course, will be dictated by you guys. Claude, is BrainChip one of those companies that you can get really excited about? Of course, it's AI, and it is going to apparently, according to the company, really change the way in which computers are worked and data is processed. What do you think?
I mean, so I wrote an article about this quite a while ago now, when it sort of first got hyped up and become a sort of ridiculous meme stock. And the share price is lower since then, and that must have been a year or more ago. So I guess that the company's running out of new people to throw their money in the well, I guess. So what this company does is raise capital from the market to develop this thing, like you said, that is supposed to be revolutionary, but it doesn't make money or anything. And you can't go out there and buy their product or anything and check it out and see if it's revolutionary yourself. Now that really sits in contrast with a lot of the other companies that I would still classify as high risks, who actually have a product that you can jump on and see and be like, ask yourself, hey, do I think this is going to grow? Is this a great product? Some of those companies are listed and they make a loss, but they've got growing revenue and you can check it out yourself. BrainChip's not like that. In fact, I don't think that most of the shareholders even understand what all this computer chip talk is, like the science of it. Like, have I gone crazy? And like, why is it that like I can't understand any of it in any proper way, yet people that work in, accounting, law, trades and all this sort of stuff feel that they can call it and say this is a really great product that's going to revolutionize the world? I mean, I don't think that the shareholders probably want you to give more time to me to talk about BrainChip, because I've got way more where all this came from. First of all, just look at the market cap and look at the amount of money they've spent on R&D to create that value of the market cap. I mean, it's phenomenal. These other big companies that are working in computer chips and stuff, they spend absolute hundreds of millions and stuff. And I think these guys are about 4 and 5, there's way less than that on R&D. A few years ago, it was like 4 million a year or something like that. But, it might have gone up from there because they've managed to raise more capital because their share price goes up. I also would check what the CEO's been doing. I think I saw a few change of director's interest notice there where it looks like he was disposing of shares there. So, that's not generally the sign I look for to be super bullish about a stock. So, it's a hard sell from me.
Got it. Jun Bei, I mean, do you risk missing out on the next big thing in, quantum computing space and AI and all of these things that, again, it sounds good, especially when there's a semiconductor shortage on? Or do you just sit back, in your view, watch, wait, see what happens in the long term?
I would say that for this one, definitely watch and wait. It got pretty hot because everyone was talking about it, become one of the most popular stock that was traded by retail investors. But the company, like Claude said, the company doesn't make money. And one of the thing about investing early stage business is that you do want to see path to commercialization, whether there will be you partnering with certain places and whether there will be potential interest from partnership, and that will take you to the next level. So before you get there, it's just a little bit too speculative. While it sounds great in the neural computing space, it is where the future is. But like Paul said, lots of people are throwing money at that space, and we're not sure who's going to be the ultimate winner. It's good that they invest in this space, but you need to watch to see more deals, contracts, commercialization path before you should really put any money in it.
Yeah, because we're glad that people are doing this type of work to move technology forward, but you just don't necessarily feel the impetus to put your money into that story at this time. Guys, thank you so much. I really enjoyed that show. As always, really appreciate your insights, as I'm sure our viewers do as well. It's pretty much the weekend. We do hope you have a good one. Thank you, Claude Walker from A Rich Life and Jun Bei from Tribeca Investment Partners.
Thank you. Have a great weekend.
Thank you. I'll just quickly sum up what we, talked about in that last half hour. So, number 6 on the list was Safehouse Group, and this is Claude's second favorite stock that we were discussing today because it's looking to solve a real problem in the world. It's been growing. In fact, it's been growing in a good way. It's, he sees a lot to like about it. It is just a bit of a hold for him right now because you've missed that big leg up, which, may still come to fruition, but it's just a bit expensive for him right now. Jun Bei calls it a hold. She's interested. She says it's very interesting. Bit of work to do on valuation, so she's going to continue to look at that one going forward, but can't endorse it with a buy today on that. Seek, it's a hold for Claude. He says it is high quality management team, but for him, it's a bit too expensive. Not so for Jun Bei. She would be buying at today's level one of the top companies in Australia. Just be aware, earnings can be a bit cyclical, but right now it is a buy. Horizon Oil, Jun Bei will stick with the big boys in town. It's an avoid for Claude. He doesn't have an edge in that one, and it is cyclical as well. Challenger, it's just a bit lackluster for both of my guests. It's not exciting. It's not exactly cheap in Jun Bei's view, so it's a hold for her and a hold for Claude as well. Perhaps a father-in-law stock. Brainchip, you just heard them talking about it. Meme stock. In Claude's view, not a place you put your money. Too risky, too specky for Jun Bei Liu from Tribeca as well. Thank you for watching or listening, however you choose to consume this program. If you'd like us to comment on a stock and get some insights from our expert guests, you can email us at thecall@ausbiz.com.au. We're always on Twitter, constantly. We're at ausbiztv. You can do it that way as well. Sometimes it does take a couple of days, maybe even a week or two for us to get to all of these requests. If you send it on the day, I can tell you it's very unlikely that it will happen through that Twitter universe, but thank you. Keep doing it regardless. If you'd like to check out that portfolio, it's at the bottom of your screen. And stay with us. It's Friday, and that means Gemma Dale is here. She's going to tell us what's been running through the NAB Trade platform. So where Australians have invested this week and where they've pulled their money from. That's coming up next on AusBiz.
Currency play here. What are you expecting? Is it a euro trade?
For me, it's using a wider trading stock and trying to capture those big medium-term trends.
Generally,